Hello, everyone, and welcome to PCR's February Tips and Virtual Transition Times meeting. My name is Melissa Wyman, and I will be your moderator this evening. So please feel free to send any questions or comments in the chat box below. We are so excited to be collaborating with Montgomery County Public Schools Transition Services Unit to provide an enhanced transition times program for transitioning youth, their families, and caregivers. We are delighted to offer this presentation with American Sign Language simultaneous interpretation. We will also be offering this presentation with Spanish simultaneous interpretation and Amharic simultaneous interpretation. To access the other interpretation services, at the bottom of your screen, select Interpretation. Select Spanish for the Spanish interpretation and select Chinese for the Amharic interpretation. Mute original audio if you only want to hear one language. The English and Spanish versions will be archived on the PCR website Transition Times page. Just some Zoom tip reminders. We are using the webinar platform. We will wait for questions at the end of the presentation, but feel free to submit any of your questions in the chat box below. Click Show Captions to see the captions for the webinar. You must select the speaking language you would like to show. Also, for funding needs, it's very important to receive your feedback about our webinars. Please answer the one question poll by the end of the webinar. I will put it in the chat. Thank you for your help and feedback. Tonight, we are so excited to have two wonderful presenters that will provide informative information about financial planning, specifically special needs trust and ABLE account. Our speakers are Yolanda Mazik, CEO, Shared Horizons, Inc., and Kelly Nelson, Outreach and Communities Manager, Maryland ABLE. Yolanda?
Hi. So thank you so much for yet another opportunity to share. This is, I have to admit, one of my favorite presentations to do, only because we always get a few or several calls after. So thank you so much for allowing us to share this information. So as Melissa shared, my name is Yolanda Mazik, and I'm the CEO of Shared Horizons. And Shared Horizons is the nonprofit organization created to manage pooled special needs trusts. We actually manage two. We manage a first-party pooled trust, and we manage a third-party pooled trust. So I think what I've not done in the past, and if we can go to the next slide, is share a little bit about who Shared Horizons is so that you don't think that I'm just someone coming off the street to share information. I've already shared that we're a nonprofit organization. We're 20 years in the works of serving people with disabilities, their families, and their support network. We focus on really delivering individualized or person-centered trust services, and we try to do that every day with compassion, with integrity, and commitment. Those are really important for us. We always hear in the news where oftentimes folks with disabilities are often taken advantage of with their finances. So it's important for us to remain above the fray and make sure that we are delivering services that with much integrity, but also with that compassion and commitment to do always the right thing. We can advance to the next slide. So we're here to talk about estate planning, or specifically, I'm here to talk about trust, but I can't really talk about trust without doing a little blurb on estate planning. A lot of people come to me or when I'm doing a presentation and they say, I don't have anything. We're not wealthy. I don't have a lot of money. And I always say to them, it's not just for the wealthy. And you don't need to develop an estate plan. Estate planning is really crucial for everyone. I'm in the process of really trying to work on my estate plan because I own a house, I have insurance policies, I have a daughter, she has a son. So I want to make sure that my gift to my daughter is that if something happens to me, she does not have to deal with probate for anything. So it's important for me to establish that estate plan, but it is especially important for families with a child or children with disabilities to establish that plan as well. The next slide. So I want to just briefly talk about just a few key points when you're thinking about estate planning. And there are three areas of focus. The first is paper. You want to make sure that you secure an attorney that will help you organize your documents, create the will, guide you through the process from the beginning to the end. And that's really important because if the papers are done incorrectly or filed incorrectly, then it creates an issue for your heirs and your loved ones. So securing an attorney, and let me just say, an attorney that has experience with estate planning is critical. And for those of you that are wondering, I can't afford an estate planning attorney, I would encourage you to look up, Google estate planning attorneys in Maryland and pick up the phone and call, because sometimes you'll find there are firms that offer either reduced rates or pro bono services for folks that are unable to secure or to pay for services at a higher rate. And then the other area of focus, obviously, is money. You want to seek advice from someone, either an estate planning professional or a financial person, because you want to make sure that the money or the funds that you do have are actually in a vehicle that would allow you to leave to another person or include as part of your estate plan and your will. And the other part of money is, in addition to finding out where the money is, what type of money it is, you want to make sure that part of that money plan or focus is you want to establish a third-party trust. That third-party trust can be either an individual trust, and we also call that a standalone trust, or it can be a pooled trust. And I just want to say, and I know I'm probably going to get into pooled trust a little later, but I want to just say briefly, a pooled trust is simply a trust that's managed by a nonprofit organization that has one master trust document that's been vetted and approved by Social Security, and it's been provided by the state Medicaid program, so that the only thing you need to do is to complete a joinder agreement to establish an account within that pool. But I do want to say before I leave that portion is that, I want you to hear this, that the trust portion of estate planning is really only a small part of the big picture of estate planning. And then, of course, the third area of focus that attorney should help you think through is people. I know I talk to parents almost daily, and the one thing they say is, okay, what will happen and who's going to be there for my son or daughter or grandchild when I am no longer here? And that's pretty scary for parents that have children or a child with special needs. So they're going to spend a little bit of time talking about and helping you develop that support network. And when you think about that network, think about people, not just family members, but they can be friends in addition to family members, and they can be church, if you belong to a church or synagogue. It's thinking about who is going to be there that has a history or knows your son or daughter, that can be a part of the process when moving forward with implementing your estate plan. So can we move to the next slide? I see that there's an echo while I speak. Does everyone hear an echo?
I'm not hearing an echo, but
Okay,
I know somebody, yeah, and some people are saying no echo. So I think you're okay.
okay, okay,
Perfect. Thank you.
great, great. So this is all about planning ahead. I found this slide and I was so proud of myself because I actually love this slide because they spent all that time spending or painting the plan ahead that they actually didn't plan ahead to make sure that they could fit the full sentence on the full statement on the billboard. So it really is important to plan ahead. Next slide. So why is planning important for families with loved ones? So we all know that whether your son or daughter or grandchild receives benefits right now or you know that they're going to need them in the future, it really is about protecting those much needed public benefits, whether they currently have them or you believe they will be eligible for them in the future. And as you continue to think through the planning, I want you to think through to the age that your son or daughter may be 18, because 18 is the magic age that they will not, or Social Security will not use your assets to determine whether a person is eligible to receive public benefits. So when they turn 18, they are an adult. They're considered an adult, and Social Security will use their assets to determine whether they are eligible for that benefit. So the benefit that I'm talking about are means-tested benefits. Means-tested benefits are, supplemental security income, also known as SSI. There's Medicaid, and there's subsidized housing. And for today, we're really going to focus on, as I get into my presentation uh, centered around special needs trust, we're going to really focus on the supplemental income or SSI and Medicaid. And then the other reason it's important for families with loved ones with disabilities to plan is it takes some of the worry out of what will happen when I am no longer here or we are no longer here to support our son and our daughter. It's about peace of mind. And I have to tell you, every time I work with a family and they are working with an estate planning attorney, and then they come to us to complete the joinder agreement that establishes that third party trust within our pool, and then they submit that to the attorney that's completing the estate plan, I always get either a call or an email saying, ooh, I feel so much better because it's a relief that I now have something in place that was well thought out, and I had people that helped me think through things so that I know that our wishes were being included or were included in that process. So that's really important. Next slide, Margaret. Okay, so why plan with an experienced professional? I include this slide because, there are folks here that of means. These are people of means. Warren Burger, a Chief Justice of the U.S. Supreme Court, he relied on do-it-yourself documents. He did it himself, and he left out key provisions that impeded his estate planning um, process or documents. And then Heath Ledger, he did an estate plan, but he did not update it. And he didn't update his will after the birth of his daughter, and she was excluded. And if you've never been in probate, probate is everybody tries to avoid probate because it can be a long drawn out process. But if you don't update your documents as life events happen, then it's going to create problems with the folks implementing that. And you really don't want to leave anyone out in your family that you want to include and to benefit from your estate plan. And then Florence Flojo, she forgot to tell people where her documents were located. And it took 4 years to close her estate. And then, of course, we've all seen in the news, I don't know, a number of years ago, when Prince passed, he didn't have a will, nor did he have an estate plan. And we all know how much money Prince had. Um, and his estate closed in 2022 after 6 years in probate. So why is it important to plan with an experienced professional? Because all of these things that are listed on this slide, they're going to prevent those things from happening. And they're going to make sure that you are not just including all of the information needed, but they're going to also encourage you and tell you that you also need to revisit your plan periodically. There are attorneys that have different timelines. Some will say you need to update and you need to revisit your plan every 3 years. Some say every 5 years. And then, of course, all should say when an event occurs, you need to come back and you need to update your plan to include whatever change or life event occurred that did not happen previously when the plan was completed. Next slide. So we're going to just briefly talk about the benefits because it's really important for you to understand. There are three types of benefits. There's the cash benefit, there's the insurance benefit, and then there's the potential of housing benefit. So the cash benefits that your loved one will potentially be eligible for will be Social Security, disability income, which is also known as SSDI. That's not means tested, nor is it needs it, I'm sorry, not needs tested or needs based. It is simply, they either had your loved one had enough work quarters to qualify for SSDI given their disability, or you have a parent that either has now a disability or passed away, and that person would be eligible for SSDI. And then there's Social Security retirement, also not means tested, nor is it needs based. And there's railroad disability retirement that's not means tested. But the big one that we're going to really want to protect is, as I mentioned earlier, the supplemental security income, which is the SSI. It is means tested and needs based. So what that simply means is that means tested means that they have to be under a certain asset and income limit to qualify. So in order to receive supplemental security income, Social Security says you can't have more than $2,000 in assets, and your income has to be under a certain threshold in order for you to qualify for SSI. Can we proceed to the next slide? And then, of course, there's medical coverage and services. So if the person receives SSDI, they will qualify for Medicare after 2 years of becoming eligible for SSDI. and that's connected to Social Security as well as railroad retirement benefits. The benefit or the medical coverage that we're really concerned about at this point related to the special needs trust that is means tested is state Medicaid. State Medicaid is means tested and it's needs based. There's no Social Security or railroad connection to receiving that benefit. Medicaid is the benefit that, let's say your son or daughter is moving into DDA services or DDS services. I'm sorry for the stutter. And they're working with a provider agency, and they may work with that provider and live in a group home, or they may live in a supported apartment. State Medicaid is the benefit that's going to cover much of those services if they're in a group home or in a supported apartment. They cover that provider agency's costs in delivering much of the services that they're to receive through that group home setting. And then, of course, the last benefit is HUD subsidized housing. In Maryland, you know, every state or every jurisdiction has a housing program. And most of the time, you'll find that there is a huge or long waiting list to qualify. However, sometimes if you are with DDA or you're with a provider, HUD provides or may often give provider agencies vouchers or access to vouchers to allow those folks that they're supporting to qualify for and to move into that subsidized housing. So the important thing is that when you are talking to a provider agency, that you ask that question. You ask the question, who's going to pay for the housing portion? Is it going to be Medicaid? If they living in a supported apartment, living somewhat independently, is that going to be subsidized through HUD? So those are some of the questions that you might want to answer or ask and get an answer so that you are aware of the type of housing and that your son or daughter may be eligible for. And I want to note that benefits dictate how disbursements are made from a special needs trust, which is why it is important for, you know, when you're looking for someone to be the trustee, that they have a clear understanding of all of these benefits that income or assets can jeopardize if they are over the threshold. We have to know what those benefits are, how cash will engage those benefits, and what rules we have to follow when making disbursements from the trust. Next slide, please. So let's talk about what should be included in the plan. The first is, and I've said this earlier, you know, you want to retain a good estate planning attorney. You want to engage an attorney that has experience, that has done not one or two or a number of estate plans, to ensure that they are actually looking at all of the scenarios and the columns that will need to be addressed in your estate plan. They're going to help you review your assets. They're going to have you look at your bank accounts, your equities, your life insurance, the property that you own, whether it's property that you live in or property that you rent, you know, all of that property you own. So they're going to want you to look under every rock for all of these things, as well as your retirement. And then that estate planning attorney is also going to talk to you about developing a special needs trust. Next slide, please. So I'm going to talk about how special needs trusts came about. Um, Back in 1993, Congress created three exceptions, and they called it the Ober 93. So those three exceptions to the general rule that a person's assets held in a trust are counted as a resource when determining eligibility for Medicaid. So the three exceptions are a standalone or individual special needs trust. Sometimes you'll see the acronym S&T or SNT. The other is a disability income trust. That's for folks that are retired and they find that they have a disability, but they need to qualify for whether it's Medicaid or another type of benefit, that if they were to receive that income on a monthly basis, they would not be eligible to continue to receive or to receive that service. I will say that it is unclear in Maryland whether they accept a disability income trust. I'm still trying to research that, and I can't, I just want to make sure that you know that I'm not sure if Maryland accepts those trusts. But I would venture to guess that most of the people on the line tonight are not necessarily interested in a disability income trust. And then the third is a pooled trust. I saw that someone asked the question about pools. So I said the pooled trust is a pool that you are allowed to pool assets, and you are allowed to have one master trust document that encompasses the full pool. And then the only thing you have to do to join the pool is to complete a joinder agreement. So Shared Horizons has two. We have the Wesley Venner Memorial Trust, which is our first party trust. And what I mean by first party, and we're going to get into this a little later, but first party means that the money already belongs to the person that has the disability that we are creating the trust for. That's a first party trust. And then the third pool trust is the Shared Horizons third party community trust. That's the trust that I would guess most parents on this call would be most interested in. The third party trust is an opportunity for parents to develop and work with that attorney, estate planning attorney, to draft that estate plan and include a third party trust within that plan. And I also want to say before I leave this slide that any trustee must adhere to the sole benefit rule when making disbursements from a trust. And I'm going to get into that a little later in the slide. Can we advance to the next slide? So people can choose from three different types, and I've already talked about, whether the Miller Trust, and by the way, the Disability Income Trust is also called a Miller Trust. And I'm thinking that Maryland does not recognize, nor does DC, but that's something that is still unclear to me on Maryland's end. But then the choice remains just two options. And I'm going to tread lightly here because many times this can get confusing. So a standalone trust or an individual trust is a trust that is, you hired an attorney and that trust is drafted by an attorney that has experience drafting special needs trusts. That document has to be, if it's a first party trust, that document has to be submitted to Social Security and to the Office of Attorney General, the state Medicaid program. And then once that is approved and they put their stamp of approval on it, then your job is to find a trustee. That trustee can be, if you decide to fund it immediately, it can be you as the parents while you are living, but then you have to look at who's going to step in when you are no longer here to serve as trustee. For a pooled special needs trust, the attorney drafted master trust document and is already drafted. We had an attorney, and I believe one of our general counsel may be on this call tonight, but our our general counsel and we hired an attorney to recently restate our master trust document. That document is in the process of being approved by Social Security and the Office of Attorney General. Now, we are still operating under the old trust, and they still acknowledge the old trust until they review the restated document. In order to join the pooled special needs trust, the parents must complete and sign a joinder agreement. The joinder agreement is the binding document that establishes your relationship with the trust. For the pooled special needs trust, the nonprofit serves as the trustee. So in our case, we, Shared Horizons, as a nonprofit organization, will serve as the trustee. So you will not have to find a trustee when joining a pool. Now, it's important for us to understand also that either a self-funded or the third party can be, and I'm sorry, I need to use the same language. The first party trust, which means the money belongs to the person with the disability, or the third party trust can either be standalone or it can be a pool. And that's where a lot of times parents become confused. But I will leave my information after my presentation or as part of this presentation slide to make sure that you have my contact information so that if you want to get into more or greater detail, I'm happy to facilitate an opportunity to talk to you, whether it's over Zoom or over a telephone. So next slide, please. So over 93, which is the Omnibus Budget Reconciliation Act that I talked about, that created the opportunity for special needs trusts to exist. I'm going to focus on the requirement for a pooled special needs trust, which are the primary trusts that we manage. Congress said in over 93, they said that in order to manage a pooled special needs trust, the entity must be a nonprofit or it must be managed by 501c3. Shared Horizons is a nonprofit that manages that pool trust. The trust must be irrevocable or irrevocable. That means that once the trust is funded, a person cannot just change their mind and request the money back. You can, however, move to another trust if you allow for that in your estate planning documents and in your trust document that will allow not the person with the disability, but someone else to transfer to another trust. The other is for the pool, even though resources are pooled for investment purposes, we must keep separate accounts and we must maintain each of those accounts for the benefit for each beneficiary that joins the trust. But again, the assets are pooled for investment and management purposes. So the best example I can give is Erica. Your daughter's name is Erica, and she joins the pool. And the pool and her trust account is funded. You're funding that account with, let's say, $50,000 or $100,000. Even though we're gonna add that 100,000 to the 40 million that we have under management, Erica still has the $100,000. The key to that is that instead of us having to find investment tools and products to invest that $100,000 in, Erica is going to be able to enjoy the 40 some million um, uh, documents, or I'm sorry, products that we have that will potentially provide her with a better rate of return. And then, of course, accounts must be in a pool, and with any account that's a special needs trust. Accounts are established for the sole benefit of the person that has the disability. And that's a PALMS rule that they are very serious about. And when I say PALMS, I mean that's the document that Medicaid, or the manual that that Social Security uses, that helps their folks interpret and follow the guidelines for as they work with people that are receiving Social Security benefits, whatever those benefits may be. And then for self-funded trust only, and you can see it's in light gray. I did that purposely because really for tonight, we're really focused on the third-party trust. But I did want to just briefly say that for self-funded or first-party trust, meaning the money belongs to the person that has the disability, that person, as long as they are 18 and have capacity, a parent, a grandparent, a legal guardian or conservator, or the courts can establish a self-funded trust on behalf of a person that has a disability. And then for the self-funded trust only, if there are funds remaining in the trust and the person passes away that the trust was established for, then Medicaid has a right to submit a lien to be paid back a portion, if not all, of what they paid out in Medicaid benefits. And again, I'm not going to go into detail on that because that's really probably not what you're interested in. But I think the key point here is that the important, and why estate planning is important and drafting or joining a third or establishing a third party trust, is that there is no Medicaid payback, because in a third party trust, you are saying that you want your assets upon your demise to go directly into whatever third party trust you created. It never goes directly to your son or daughter. So Medicaid has no right to lien for those funds because those funds were provided by a third party. Next slide, please. So the benefits of a pooled trust is that you don't really need to hire an attorney to draft the trust document. That part has already been done. There's one master trust document that's been drafted by a special needs trust attorney. Again, that part has already been done. The other benefit is that, and I mentioned this earlier, because funds are pooled for investment purposes, there's a bigger pot. For us, it's over $40 million. We can purchase better products that could potentially provide a greater overall return with your portion of that your loved one has in the trust. And also typically, pooled special needs trusts are less expensive to create because you're really only paying for the enrollment fee at the time that you create the document. And that enrollment fee varies from trust to trust. And remember, the trust is only a small part of the estate plan. The estate plan is a bigger picture of what will happen to your estate, every column and every area that you that attorney is going to focus on for you. Next slide. So how does it work? So funds are pooled for investment purposes only. The nonprofit, and I need to change this, but we now are the manager of the sub account. We manage the individual accounts for each beneficiary. For Shared Horizons specifically, we work as a team. We engage a team approach that is person-centered, that always puts the beneficiary front and center when making disbursements, when creating plans for the trust. The beneficiary is always the center focus. We take in consideration the benefits that they are currently receiving when making disbursements from the trust. We take into consideration the account balance, the beneficiary's budget and costs. We make sure that we are doing no harm to the person or to their benefits. And we're looking also at other resources. We've been fortunate in this country to have a Congress way back in 2015. I believe it was President Obama that signed into place, that created the ABLE accounts Kelly, that you'll hear more about after this presentation. And that's key because the ABLE account allows, and it's a savings account that you'll hear more about, allows for more flexibility when paying for goods and services that a special needs trust does not and cannot. Next slide. So how can my family, you're wondering, be involved in the process? So there are a number of ways that your family can be involved in the process. They can be a representative, and I want to specify that the term representative that I'm using in this context, it's not a legal term. It is simply a term that we as a pooled special needs trust manager created that describes a person that serves as or acts as the liaison between the beneficiary and the trust. That is only if the beneficiary does not have capacity to engage us direct. So the representative could be anyone that you name in your document. It could be a family member, it could be a sibling, it could be a friend, it could be a provider agency or a person within the provider agency that's supporting your son or daughter. But the important thing is that, we want to make sure that that representative has an ongoing established relationship with the beneficiary, that they are also going to understand that they're going to make requests on behalf of the beneficiary to the trust. They may be they may be asked to research requested items to help and assist with the trustee making the disbursement. And they're also going to be asked to meet with the beneficiary and the trustee as needed, or the manager as needed. The other two are the trust advisor. So the trust advisor advises us as the trustee, and that's important because sometimes when we have a beneficiary and we recognize that we can't be all things to the beneficiary, we just cannot. We are the trustee. We hope to have a support network that will be involved in this process that will help us make the best decisions possible for what kind of distributions we will make from the trust. So the trust advisor will advise, but they cannot and they do not direct disbursements. The trust protector can be, again, anyone, family member, a friend, the provider agency. The trust protector ensures that the trustee adheres to your intent of the trust. So the best example would be that there's a request being made, and you as the grantor that created the trust gave us certain guidelines that you want the trust to be used for. And the request that is presented to us does not fit within those guidelines. The trust protector is going to step in and say, you know what, that was not included in our loved ones or the grantor's wishes for this trust to be used. So that trust protector is going to make sure that we're adhering to your rules. Now, I do want to say this, that a lot of times when you are drafting your estate plan and your documents, your joinder agreement, a lot can happen because remember, you're drafting it maybe today, tomorrow, next year, but it probably won't be funded until an event occurs. So until you pass away or someone that has listed the trust as the beneficiary on behalf of your son or daughter funds that trust, it's going to remain dormant, or it's going to remain a shell trust, or it's going to remain empty until that funding occurs. That can be a long time. So it's important for us to make sure that once the joinder agreement is drafted and the estate plan is created, that you are going back periodically to review those documents to ensure, one, that there wasn't a family event that changed some of the language in the trust document or some of your wishes in that trust document. You're also going to make sure that you are revisiting the trust document to ensure that, your loved one every year, they're going to grow, they're going to age, their disabilities may change, their needs may change. So, and the gaps in services may change. So you want to make sure that you are revisiting that periodically while you are living. I will also say that once that account is funded, our job as the trustee is to make sure that not only are we following your wishes and intent, but we are looking at the needs of the beneficiary and where the gaps in services are and how we can enhance their quality of life as much as possible. Next slide, please. So disbursement rules, there's nothing basic here. Social Security, and I didn't update this slide, I apologize, because it says SSI prohibits payments for basic needs, housing and food, may cause a 1/3 reduction. They have recently, as of September of 2024, they removed food from this. So now special needs trusts can pay for food from a trust account without jeopardizing or causing a reduction in the SSI. But what hasn't changed is if we provide cash, their SSI will be reduced dollar for dollar after the first $20. So these are the rules that we have to follow when making disbursements from the trust. And of course, Medicaid says we're not supposed to supplant that Medicaid benefit, but we can supplement that benefit. The best example I can give is that Medicaid says, listen, we will pay for one pair of glasses every 2 years. But let's say your son or daughter has a history of throwing their glasses, losing their glasses, breaking their glasses, sitting on their glasses, and you need another pair. Medicaid is not going to cover in that 2-year period. So we can supplement that by paying for as many glasses during that time period until Medicaid, then the 2 years are up. So that's the best example I can give when it comes to supplementing the Medicaid and not supplanting it. We can't pay for things that Medicaid covers, but we can supplement what Medicaid either does not cover or they've covered, but we need a next level or we need additional services on behalf of our beneficiaries. And I'm not going to go into subsidized housing, but it is important to remember that the trustee, whoever that trustee is, whether it's within a pool or you name someone as a trustee, the trustee has, or the manager has, total discretion when making disbursements or choosing to make disbursements from the trust. That's why that quality of life planning meeting is really important. And then the last, I think if you can proceed to the next slide. This is an important slide too, because it shows the difference between S&Ts or special needs trusts or pooled special needs trusts and ABLE accounts. And Kelly is going to share a little bit more about this after we're finished with this portion. But there's no annual or lifetime deposit for a special needs trust. But ABLE, you can only do 19,000, and I'm not going to get into the details because Kelly's going to do that for you. There are for the special needs trust, there's significant trustee oversight of funds and distributions. Kelly's going to talk a little bit about how that works for ABLE. For the special needs trust, we cannot distribute for basic housing with the exception of food without causing a reduction in SSI. Kelly's going to talk about how ABLE reviews or engages in those kinds of basic housing or basic living expenses. And for the special needs trust, remember, there's no Medicaid payback for third-party trusts upon death. And then Kelly will talk about whether there's a Medicaid payback for Maryland, and I don't think there is. And then income earnings are taxed in a special needs trust. I'm not sure if Kelly's going to get into this for the income earnings for the ABLE account, but if so, then she can respond to that. And then it is more costly to administer a special needs trust, and it is less costly to administer the ABLE account. However, what we're finding a lot of families are doing is they are including the ABLE account or allowing or requesting ABLE distribution from the special needs trust that is established. So Congress right now allows special needs trusts to deposit money into ABLE accounts up to that 19,000 right now per year. So why that's important is, it's the best of both worlds. The trust and the ABLE account can work together to make sure that the person's or your loved one's quality of life is going to be enhanced to the fullest. So that's all that I have with my regarding special needs trust and estate planning. And I think the last slide sort of just gives my contact information. Should you have additional questions or you just want to sit and talk about, what you should do moving forward.
Okay, thank you so much, Yolanda. So we have a few questions. So the first question is for pool trust, what happens to the money after someone dies?
It depends upon whether it's a third party. A third party, you tell us how you want the remaining disbursements to be made, and we follow that. The people that you list will have to file or provide us with the W-9, and that will be reported to the IRS. But you tell us how to make disbursements for the third party. The first party, it's Medicaid payback, and then, as a nonprofit organization, Medicaid allows us to retain 50%, but that's for the first party. But for the third party, you tell us how you want that to be distributed.
Okay, thank you. What are the fees to manage the pool trust, and are the fees billed or withdrawn monthly, quarterly, annually, or yearly?
So there's a one-time enrollment fee to establish an account within the pool of $1,500. That covers us sitting down with you, working through the whole joinder agreement process, which can take a little while because there's a lot that you have to think through when completing that document. And then the annual fees, it's based upon the balance in the trust, and that is divided into quarters.
Okay, thank you so much. Um, and then another question is, what is the difference between a disability trust and regular trusts?
So the disability trust is a trust that only protects, it's the only trust that protects means tested benefits. A regular trust does not have the language and has not been vetted by Social Security and approved by Social Security. So if you put money in a regular trust, that will be counted as an asset, and it will prevent or interfere with loved ones being eligible to receive SSI and Medicaid benefits.
What were the annual returns for the pool trust last year?
You're going to have to call me on that because I don't know. So whoever asked the question, please call me and I'm happy to give you that information. I just don't know offhand what it was. I don't
Okay,
want to give you the wrong information.
of course. All right. So next is how often can the joinder agreement can be updated if we need to make changes to the representative, trust protector, etc.
As often as you need to.
Okay. How does SSDI work with a pool trust and how does it impact SSI, Medicaid, etc.?
So the pool trust does not impact SSDI because it's not a means tested benefit. The trust does not impact, as long as we follow Social Security and Medicaid rules when making disbursements, it will not jeopardize any of the means tested benefits, SSI and Medicaid. That's why it's important for whomever is going to manage your special needs trust, they understand the rules that Social Security and Medicaid put upon you, because if they make a disbursement that jeopardize that benefit, your loved one could lose those benefits long term.
All right, thank you. And one last question. If you establish a trust, do you need to define how much to fund up front, or can it be decided later?
So we just ask for an estimate. It can be, you could just throw a number out, but as you're going through the estate planning process, the attorney is actually going to help you determine what assets you're going to have to leave to your loved one. And for those of you that have multiple siblings or multiple children, they're going to say, okay, you need to divide it by the number of children you have, and then estimate how much is going to flow into the special needs trust for your loved one with a disability.
Okay, great, Yolanda. And one more question. Can you just define what means tested benefits is?
Means tested means, I should not have used it twice, the word
Eh,
twice. Sorry about that. Means tested simply is a formula that they use that says they're going to look at your assets, what you have in your bank accounts, all of your bank accounts, and they're going to look at your income to determine whether you are eligible for means tested benefits.
okay,
SSI is $2,000 threshold in all of your bank accounts. And the income, I don't have the income threshold at on hand right now.
okay. Thank you so much, Yolanda. All right, and now we can get started with Kelly. All right, you are spotlighted.
All right. Well, good evening, everyone. Thank you so much for joining us tonight and for hanging in there for the second part of our series this evening. My name is Kelly Nelson, and I'm the Outreach and Communications Manager for the Maryland ABLE program. I always like to share with everyone that in addition to working with Maryland ABLE over the last 6 years, I'm also a parent of a young lady. She's 20 years old, has multiple disabilities, and she has had an ABLE account for the last 6 years. And I share this because um, I've had this opportunity to have some real practical life experience with ABLE, as well as just sharing all the regulations and benefits and features. I've been able to see that firsthand by watching my daughter grow in her independence, in her decision making, also learning some financial literacy skills, as well as giving her father and I a way to begin to plan and prepare for her future. When we're not here, hopefully decades from now, we want to have everything in place for her. So that's what this evening is all about, is learning about that financial planning piece, making sure our family members have everything that they need while we're here and after we're gone. I'm so grateful that I get to be on a panel presentation with Yolanda, because she does such an amazing job of explaining means tested benefits and benefits for people with disabilities, such as Social Security SSI cash benefits and the SSDI, as well as the importance of being eligible for that Medicaid piece, which is the health insurance, which oftentimes opens everyone up to be able to apply for different types of waivers, such as that food, energy, and housing assistance, right? So what we're going to shift a little bit now and talk about ABLE accounts. ABLE accounts are the second way that a person with a disability is able to save and plan for the future while still maintaining those critical benefits, SSI, Medicaid, pardon me, and waivers. So Yolanda did a great job covering everything about the different types of trusts and how they are served as a way to protect those benefits and be able to plan for the future. So we're going to go ahead and look at ABLE accounts as that second way to be able to do that. So back in 2014, President Obama signed into law the Stephen A. Beck Jr. Achieving a Better Life Experience. That's where we get the acronym ABLE. And we just call it the ABLE Act now. But when this ABLE Act passed, it gave states across the nation the opportunity to open up ABLE programs and make ABLE accounts available to people, which gave them the opportunity to be able to save beyond that $2,000 asset limit that Yolanda was talking about. And when a person has money in an ABLE account, they're actually able to save up to $100,000 in an ABLE account and still maintain SSI cash benefits, Medicaid, and all types of waivers. So we see where this is a real game changer for people with disabilities, because prior to special needs trust and ABLE accounts, there was no way for them to be able to save and plan for their future, because they couldn't have more than $2,000 in assets combined. So this has been a very helpful tool. Here in Maryland, we were signed into law, the ABLE Act, by Governor Hogan in 2016, and we launched our program in 2017. So we're a little over 7 years old here in Maryland. And to date, we have over 7,222 Maryland ABLE account holders who together over those last 7 years have been able to save over $105 million in assets. So this is such a wonderful tool, because that's a group of people that normally would not have been able to have more than $2,000 apiece. It's important to note that ABLE accounts are due to that federal legislation called the ABLE Act, and our regulations for running these programs are housed within the Internal Revenue Code, Section 529A. You may be familiar with 529 of the Internal Revenue Code, as that's the college savings plans. So we have some similar characteristics. We're kind of sisters, if you will, in the Internal Revenue Code, but we also have some differences as well, and we'll talk a little bit about that. Our program here in Maryland is facilitated and operated under the Maryland State Treasurer's Office. benefits. So we have a total of 47 programs, ABLE programs nationwide, and Maryland is one of them. Okay, let's go ahead and advance to the next slide and take a look at the main reasons that people are interested in opening ABLE accounts. The first one is the one that we've just talked about, and that's being able to increase those saving limits before those SSI cash benefits would be impacted. So outside of an ABLE account, a person with a disability can have up to $2,000 in a regular checking account or savings account or a rep payee account, if you will. Within an ABLE account, that person is now able to have up to $100,000 in the ABLE account without impacting those SSI benefits. And also being able to protect the Medicaid and the other waivers that they may qualify for. Money within the ABLE account has tax-free earnings. You don't pay any federal or state taxes on those earnings, not while the money's in the ABLE account and not while you take it out either, provided that those funds, those withdrawals, are used for the benefit of the person with the disability. Also, another benefit, another tax-advantaged benefit would be contributions that are made to a Maryland ABLE account can be used as an income subtraction on your Maryland state taxes. So families who are making contributions to the ABLE account can claim that income subtraction $2,500 per person, or if mom and dad are married and filing joint returns, that could be up to $5,000 as an income subtraction. Another benefit is ABLE accounts have really easy online enrollment and account management. I know as a parent myself, and having spoken with many families, we often find ourselves having to spend a lot of time filling out a lot of forms and applications. They're very lengthy, involved, and tedious, especially if you've been to that point where you've applied for SSI benefits. You would know what I'm talking about. But with an ABLE account, you go to our website and you enroll directly from our website. It's all online. It takes you through a series of questions, and it takes about 15 minutes for the enrollment process. And the other benefit is it's easy access to the funds, because you're going to be linking the ABLE account to an existing bank account, which allows you to do the online banking of transferring funds into ABLE and taking electronic transfers out of the ABLE account. So that's some of the main reasons why people are interested in an ABLE account. Let's go ahead and check the next slide, please. And as we were transferring to the next slide, I did catch a question there. Can you transfer SSI funds into an ABLE account? The answer to that is yes. I usually cannot read and talk at the same time, but I happened to see that question. So in order to be eligible for an ABLE account, a person has to meet two criteria. The first is that they had to have the onset of their disability prior to their 26th birthday. So we know that everyone that's on the call tonight, because you have a student in school, they're under the age of 26. So we know they have that criteria met. The second is that they have to have a disability that meets the Social Security Administration's definition of a disability. They don't have to currently be receiving SSI or SSDI, but they just have to have a disability that would meet that criteria. And the types of disabilities are varied. It could be a person with a developmental disability, an intellectual disability, seizure disorders, low vision, blindness, deafness, autism spectrum disorder. There's a lot of different types of disabilities. Usually these are going to be disabilities that are going to be present with a person throughout their lifetime and have a significant impact on their ability to work and live independently throughout their lifetime. Okay, so again, I just want to stress that if your family member is not currently receiving SSI or SSDI, you're still able to enroll them in an ABLE account. They don't have to have the benefits yet. All they would need is a self-certification from you indicating that they had a disability before the age of 26, and also just to have your physician sign a physician diagnosis form. Okay. All right. Next slide, please. It's important to know that it is always the person with the disability that is both the owner and the beneficiary of the ABLE account. So we recognize that if we open ABLE accounts for young children, they're going to need assistance managing the account because they are a financial account. And because they're not an adult yet, they're not able to manage it on their own. So in this case, we have what we call the authorized legal representative. That's what we call the ALR. And this is just basically the person that has been appointed to help them open and manage their ABLE account. Usually this is a parent or a grandparent or guardian family member. So some of you are thinking, well, I'm not sure, maybe in the future my son or daughter is going to be able to manage their own ABLE account. And that's fine, because when they turn 18, they're able to manage their own account if they want to. Many of our ABLE account holders do manage their own ABLE account. We still have a lot of folks, even after the age of 18, either require the assistance of a family member to manage the account, or simply want mom or dad to stay on as the ALR to assist them in that process. All right, next slide, please. As far as those who can qualify to open or manage an ABLE account on behalf of another person, could be a parent, it could be well, not in this case, there's probably not a spouse, but for older folks that have a disability, it could be a spouse, a parent, a sibling, grandparents, or someone serving as representative payee. For those of you who may have heard about ABLE accounts years ago, we did have it originally set up in the regulations that the person that was managing an ABLE account for an adult over the age of 18 had to have either a conservatorship, guardianship, or a POA in order to do that. But the regulations have been updated to include a parent. All righty, if you want to go to the next slide. Let's talk about contributions. So if we go on to the next slide, we're going to look at some important numbers here. If a person is going to open an ABLE account, whenever they do the enrollment process, they will be asked to make an initial contribution, and the minimum for that contribution is $25. You don't have to have it be 25. You could put in more if you want, but the minimum to fund the account is $25. From that point on, whoever's managing that account is going to decide when they want to make the next contribution. And as long as that amount is a minimum of $5, they can do it however they want. They could do it weekly, monthly, every couple of months. They can set up regular monthly contributions if they want to. It's totally up to the person managing the account. The important number I want you to look at here is this $19,000 standard annual contribution limit. And Yolanda did talk about this because this is an important thing to know. If you're thinking of using the ABLE account solely for future planning, this is where we really see a need for multiple planning tools, such as a special needs trust, because of this $19,000 annual contribution limit. So basically what this means is every year, a person who has an ABLE account can receive contributions up to $19,000 per calendar year. This amount does change from time to time. When we launched our program 7 years ago, that amount was $14,000. And every time the IRS changes the gift tax exclusion rule, and that increases, it's going to automatically increase our standard annual contribution limit as well. So this year, it's up to $19,000. The balance in the ABLE account can continue to grow past $19,000. This is just the amount you can contribute per year. If you have a family member with an ABLE account who's working or will likely be working in the future, they have an opportunity to contribute an additional amount of money beyond the $19,000 a year, and that's called able to work contributions. And this year, that amount is up to $15,060. So since we have a lot of folks on the call that have students that are under the age of 18, in interest of time, we won't go too much farther into able to work, but the slide deck will be available to you. And there's another slide that specifically talks about the able to work contributions. The other number I want you to really keep in your mind is the $100,000 ABLE account balance. This is how much money a person can have in an ABLE account and still maintain their SSI cash benefits. When that amount, or if that amount the balance should grow beyond $100,000, what would happen is Social Security would push a pause button on your cash benefits, your monthly cash benefits, pardon me. And at that point, they would stop receiving the monthly cash benefit, but Medicaid and all waivers would remain in place. And at any point, a person should take a withdrawal from the ABLE account and the balance fall below $100,000. Social Security could automatically reactivate. Excuse me. My apologies. Having a little coughing attack here. So this is an important difference between money inside of an ABLE account, again, up to $100,000. Above that limit, Social Security benefits would be put on pause. Money outside of ABLE in a regular checking or savings account, $2,000. If you were to exceed the $2,000 limit, you have a certain amount of time to spend down that money. And if you don't do that within about 9 months to a year, for whatever reason, Social Security would disenroll the person and they would have to reapply all over again. Also, they would lose Medicaid and all waivers for being over the asset limit as well. And I did just see another question. Does this apply to SSDI? The answer is no. So for those of you who have a family member receiving SSDI, there is no asset limit to worry about regarding SSDI. However, oftentimes a lot of Medicare waivers still do have asset limits associated with them. So an ABLE account is helpful for that as well. And then we look at the $500,000 account balance. Again, that ABLE account balance can continue to grow. And that's a perfect example with that question for someone with SSDI, right? So let's just say they don't have the $2,000 limit. They're able to continue to save and invest beyond $100,000. If their account should reach $500,000, we would no longer be able to accept contributions, but the account balance could continue to grow through earnings. And this is something that is associated with the 529 college savings programs here in Maryland. That is the cost of a college education for a child born today. So that's the maximum amount that they can have in that account. And because we're sort of affiliated in the Internal Revenue Code, we are also subject to that $500,000 limit regarding accepting contributions. Okay, next slide, please. This is the slide that talks more about able to work. And basically, it's just saying if they don't already contribute to a retirement account or their employer is not contributing to this account, they would be able to make these extra contributions up to that maximum amount of $15,060 this year. Okay, so we can learn more about that in the future when your child is hopefully working in a job that they enjoy. And next slide, please. The ABLE Financial Planning Act was a provision that was granted to ABLE programs saying that folks who had a 529 college savings plan would be able to roll over these funds into an ABLE account at no fee or penalty, making those 529 college savings funds now accessible for more than just education expenses. Now those funds, once they're in an ABLE account, are going to be able to be used for anything at all that's going to support your son or daughter in their health, their independence, or their quality of life. So this was a really nice way for families who might have opened a 529 college savings plan when their child was born, or maybe grandma opened one. And as they're progressing through school, you may be thinking college may not be their pathway when they graduate, or when they get a certificate. So if that's the case, you can roll over funds from that 529 college savings plan. It's still subject to that $19,000 a year contribution limit. So let's just say grandma has $22,000 in a college savings plan. This year she could roll over up to 19,000, and then the following year she could roll over the rest of it. Now, I do want to point out that if any of you that are on this call have an ABLE account already open for your child, we see that this provision is going to be sunsetting on December 31st, 2025. That's this year. That is the way it is currently written. However, we do have legislation being proposed that's going to ask that this provision be extended indefinitely, that they would just remove that sunset date. But in the event that it does not pass, we're very optimistic. We have a lot of bipartisan support for this. But just in case it doesn't happen, if you're thinking of rolling over funds from a 529, it's time to get started, just in case. I will say that people say to me, well, I don't know really for sure if my son or daughter is going to go to college, so I don't know if I want to roll it over. But it's okay, because if you roll the funds over, you can still use that money to pay for a college education, room and board, tuition, books, all of it. But you're also able to access those funds for anything at all that support your son or daughter in health, independence, or quality of life. Okay, next slide, please. We don't have a lot of time to get into the specifics of the savings versus investment options, but I just want your takeaway tonight to be that if you have an ABLE account, the money in your account, you have choices of how you either want to save that money or invest it. Currently, we have a cash option, which is an FDIC insured banking product that is currently paying about 4% interest. And a lot of folks like this because they know that they're going to put that money into that savings account and it's going to be there when they need it. Other folks are really interested in the investment options, especially the younger a person is and parents open for an account, an ABLE account for a very young person. They like the investment choices a lot because they have time on their side. They want to put money into ABLE and use one of those 4 investment choices, a conservative, moderate, or aggressive option. These are mutual funds that are managed by Vanguard, and it's just something there for everybody's different comfort level. The conservative option is a portfolio in 20% stocks and 80% bonds. The moderate is going to be a 50-50 split between stocks and bonds. And the aggressive option is 84% in stocks and 16% in bonds. So it's really depending upon how much time you want to leave the money in that investment and what your tolerance is for those rise and falls of the market. We also have a fixed income option, which is just 100% in bonds. So we've tried to structure it so that there's something for everyone. The good news is you do not have to pick just one. You can have one, or you can have all 5 of those, some in cash and all of the investment options if you want. It's something totally up to you. And the other good thing is you don't have to just pick it once, because every time you make a contribution to the ABLE account, you get to direct those funds to whichever one of those options you want it to be. Okay. All righty. So next slide, please. I did see another question come in. Do you have to have a letter from a doctor to open the account? You don't have to have it. If you're opening it on behalf of your child, there is a self-attestation, meaning that you are going to attest that your child does have a qualifying disability, and then you'll check off that disability code. If they're not receiving SSI or SSDI, we do recommend that the next time you go to your physician, it doesn't need to be a special trip, but next time you go, just print that form off the Maryland Able website, where it's a physician's certification form. It's a one-page form. You take it to the physician, and that person can check off the disability code and sign it. And you just want to maintain it. You don't have to submit it to Maryland Able, but in the event of an audit and you needed to prove that your child was eligible to have an Able account, you would have that to produce. All right, next slide, please. As we're advancing past the finance options and the investment options, if you want to learn more about the individual portfolios, please go to our website and read our program disclosure book, which has all the different investments as they're broken out. Able accounts, there is an annual fee of $35 to maintain that account. This is prorated, so those who open through Able account in December probably only paid $2 for the year, but it is prorated and it is assessed quarterly at $8.75 per quarter. The additional fee would be if you choose to have one of the investment options. There's a standard asset-based fee that is associated with that. Again, check the program disclosure book for that, depending upon which portfolio that you choose. You can learn more about that as well. All right, next slide. All right, who can contribute to an Able account? Good news, anybody at all. The account owner, him or herself, their family, friends. In the future, if there's employers that want to make contributions, unemployment funds, if they're unemployed at any time, back payments from benefits. Boy, this is a big one we see. Lots of times when folks apply for their child to have SSI benefits at age 18, it's taking anywhere between 9 months to a year and a half, some even more. I was one of the lucky ones that was over 2 years before my daughter was approved for her SSI benefits. And when they do approve it, they will back pay you from the time that your application was filed. So we see families sometimes in a situation where their child gets very large amount of back payment. It could be $4, $8, $10,000, depending upon how long it took them to get it. And automatically you're over that resource limit, right? They want you to have just $2,000, right? So Able accounts are a great way to handle those back payments. You can put the money in the Able account. It is now protected as being counted by Social Security, and you can still access it whenever you need it. We've talked about rollovers from 529 plans, college savings plans, small inheritances. Again, this is where we see that need for a special needs trust. Chances are when you pass away and you want to leave money or your estate to your child, it's going to be more than $19,000. You're going to need a place to put that. So that's where that third-party trust really comes in handy to be able to do that. And in the event of settlements, right? This is the first party trust. If they have a large settlement, $100,000, $50,000, whatever, that's cannot go into an Able account because our maximum per year contribution is $19,000. So that's why I'm so grateful we partner with Yolanda and Sherry as she shares about the need for those special needs trusts as well. Okay, next slide, please. How do I access the money in my Able account? Well, Able accounts are intended to be an online account management. So you would go to the Maryland Able website where you can open and enroll the Able into the Able account. And once it's set up, that's exactly how you access your funds. You log into the website, enter your username and your password, and that's going to give you access to your online dashboard. This Able account is linked to an existing bank account of your choice. That's something you would do during the enrollment process. Just as an example, when my daughter opened her account, she was 14 and she didn't have a job. She was still in school. She didn't receive any benefits, so we linked her ABLE account with mom and dad's regular Bank of America checking account, because we were the ones that were transferring money into her account, and we were the ones taking withdrawals when we needed to pay for things like her braces or her summer camps. So it made sense that we link our checking account with it. Now that my daughter is 20 years old and she has been approved for SSI benefits, she has a REP payee account. We were also able to link her REP payee account to her ABLE account. And that way I'm able to keep an eye on how much money is in her REP payee account. I never let it get a very high balance, because again, if she were to get over-resourced, meaning have over $2,000 in her REP payee account, she would be over-resourced and could be in jeopardy of losing her benefits. So I'm able to automatically just transfer those funds over to the ABLE, which it is now a protected asset, and Social Security cannot count that against her. Okay, that's the main way of getting money in and out of the ABLE account. There is another way to be able to get money out of the ABLE account. One is to request paper check deposits and withdrawals. That goes through snail mail. It takes a long time. It's not as secure, but it is possible. If folks do not have access to computers, they could do that. The other one is our prepaid card, which if we could skip to the next slide, I'd love to tell you a little bit about that prepaid card as well. All right, next slide. Oh, okay. Well, first we'll talk about qualified disability expenses, and then we'll talk about the prepaid card. We'll take a look at what you can use the money for. When the money is in ABLE, again, you can have up to $100,000. It is not counted by Social Security. It can be used for savings and investing, but you also know that you can use it whenever you need it for anything that your child needs. If you were to look in the Internal Revenue Code and to see what they say you could use it on, this is what you would find. They would tell you you could use it for any service, anything, any purchase that's going to support your child in health, independence, or quality of life. They did list a couple of categories, not to be intended to be all-inclusive categories, but just to give you guys some ideas. And that's what we're going to look at right now. Let's take that first category for health, prevention, and wellness. Many of you are probably already thinking, okay, that makes sense. That's going to be dental visits, doctor co-pays, maybe prescriptions. But look at wellness. Wellness is much more encompassing than just going to the doctor. It could be a gym membership, therapeutic horseback riding, yoga classes, swimming lessons. So you have to be able to just expand your thoughts about how it helps them in their wellness. Housing, Yolanda talked about this a little bit. So with an ABLE account in the future, you would be able to use the account to pay for rent or mortgage payments if you wanted to, or rental insurance, anything to do with the home, housing, furnishing the house, all of that is included. You're able to use it for that. Education, this could be for tutoring now while they're in school, or it could be for college in the future. It could also be for non-credit courses at a community college. Transportation, Ubers and Lyfts. If your family member may not be driving themselves in the future, they're able to use that. You can also use it for airfare, buses, and trains. But if your student is going to be able to drive in the future, they can use this money to purchase a vehicle and maintain that vehicle. Basic living expenses, that's going to include things like food, utilities, clothing. Assistive technology can be screen readers, hearing aid devices, but it's also things like your regular cell phone and your monthly cell phone service, okay? Professional services, if they need help doing their taxes, or if you're going to need help consulting an attorney to create a trust for them or a financial plan, you can use the account for that, all the way down to final burial expenses like the funeral and things, prepaid plans. Okay, so I hope this helps you to see how broad that definition is. There's very few things that you could probably think of that would not fall under improving or supporting health, independence, or quality life. But I will tell you two things that the IRS has said no. A hard no to these two things. Number one, using funds for gambling. That would include like buying lottery tickets and going to the casinos. And the second thing is purchasing gifts for other people, because the ABLE account is intended for use only by the person with the disability, the beneficiary of that account. And if they were to use it to buy gifts for other people, that would be for the benefit of others. So those are the two things we've heard about. Okay, let's see. Next slide, the features of an ABLE account. So let's talk about that prepaid card first. So one of the ways to get money out, again, is to log into the ABLE account, transfer it back into your linked account, and pay for bills. Let's use the example of summer camp. Initially, I had an account that I was doing. I had the ABLE account set up where I was just taking withdrawals out and reimbursing myself for things like summer camp. I would log in, enter her information, and when it came time to pay for the $250 fee, I would put my credit card number in there. And when the statement would arrive, I would write a check for that $250, and then I would log into the ABLE account and reimburse myself the $250 because I have a receipt for the summer camp, and that was a qualified disability expense. When we started to offer the prepaid card, I really liked this option because once I had the prepaid card, I was able to load a specific amount of funds from the ABLE onto the prepaid card. And then I was able to use that card online or in the community. So the next year I was scheduling that summer camp, I entered my daughter's information. And when it came down to payment, I put in her ABLE prepaid card and paid for it. So it was more direct and convenient access to those funds. But more important than that, this prepaid card has been a fabulous financial literacy tool for my daughter. We got it for her when she was 16, and I gave it to her on her birthday, and she was so excited when she opened it to see that she had her own card. She said, "Oh, good, now I have a credit card like my brother's, like you do, Mom." And I was like, "Oh, yeah, this is a little different than a credit card, but yeah, that's great." She said, "Can I have my phone? I want to take a picture of this and send a picture to all of my friends." Lesson number one. I mean, there's so many lessons that just come by having this card. How was she to know that she shouldn't be taking pictures of her debit card or her prepaid card and sending it to her friends? So we had this really great little teachable moment there learning about that. And there's been so many lessons that she's learned since then. One of the things is she's learning about budgeting without really realizing she's learning about budgeting, because I'm able to load her card with that specific amount of funds. She doesn't have access to all the money in her ABLE account, but rather the amount that we have set aside for her to be able to practice making choices about how she wants to spend her money or save it. So this has been a really good tool for her. In our county where she goes to school, we call these trips community-based instruction, or CBI trips. They take a lot of these trips learning to do things in the community. They will go to the grocery store with their list of things and purchase things. When she goes there, she's able to use her prepaid card, and she loves it. She was able to purchase her school supplies when she started school this year, and she picked them out, went to the register herself and paid for it. Really a great way to build self-confidence and independence and give her a chance to practice, because let's face it, guys, none of us were born knowing exactly how to budget, save, and spend. And this is a great way, while we still have some ability to do some teaching in a very safe way with controlling that money, the amount of money that they have to spend. It's a great tool. There is an additional fee for the card if you want it. You don't have to have it. You order it after you have the ABLE account. It's $1.25 per month. Whether you use the account the card 50 times in a month or not at all, it's $1.25. So for $15 a year, it was worth my convenience, just because when I pick up her prescriptions, I swipe her card. I'm just able to access funds a lot more conveniently that way. Another wonderful feature that we have here with Maryland Able is the gifting page. And I cannot say enough about this page. This is something that comes with every Able account. It is something that you create and send to family and friends that normally would give her or him presents around the holidays, their birthday, or maybe on graduation. And you can send the link by text, messenger, or email. And basically, when the recipient gets the link, it says, would you like to contribute to Yolanda's Able account? And I could say yes. I put the amount in and where I'm sending it from. I press send, and the money goes directly into the Able account, never hitting any of those other outside checking or savings accounts. So it's never accountable. And the best part is, I then would be able to take an income subtraction on my Maryland state taxes for the contribution that I made to Yolanda's Able account. So really, really nice. We have out of our over 7,000 Maryland Able account holders, over 567, I think, have launched their gifting page and use it on an annual basis. And together, over the last 7 years, have received over $5 million in gifts. So people do like that as an option. Instead of buying like another video game or something like that, they can give the gift of savings and the opportunity to plan for their future. We do also offer direct deposit features, which is one, payroll contributions for either your son or daughter in the future, or for you now, if you wanted to. If you're the ALR on the account, you could use a payroll contribution. The other thing is the direct deposit of SSA funds. So let's just say they're getting SSI or SSDI and you wanted to do a direct deposit into Able, you're able to do that. You don't have to, but it's something that people have been asking us for, and it is now available. So someone said, does the gift count towards that $19,000? And the answer is yes. So let's think of the contribution limit as a big bucket. And every year that account holder can fill his or her bucket. It could be money that he or she puts in, could be coming from Social Security benefits. It could be coming from gifts from other people. It could be coming from an employer. That bucket can be filled every year up to 19,000. That balance can continue to grow, and hopefully it does, because you have, the cash savings option that's getting returns on that, and whatever the investment returns are. But every year it's up to 19,000 unless they're working, and then they can contribute above and beyond through Able to Work. Another new feature we just added about a month ago was the mobile app. So people can manage their Able account right off their phone. It's for Android and Apple devices. So that's really good. We also have a really cool little feature called, it's an automatic savings booster. I know when I set up the Able account for my daughter, and this is not something that people need to do, I just like to share the story as a way of teaching her about savings. I did set up a small monthly contribution of $10 just because I was trying to teach her about doing, committing to a monthly savings. And then the weather boosters came along. And this is a fun little thing that you can elect to participate in if you want. But every time there's a 50% or more chance of precipitation in your zip code area, then you could make it automatically makes a contribution. And I set that for $1. So every time there's rain or snow or whatever, money is automatically contributed to her Able account. So we're having a lot of fun this winter as we've had some snow and all kinds of things, and it's kind of fun to see how little bits can really add up. So these are just some of our features. Here in Maryland, these are our features, but again, we have 47 Able programs nationwide, and everybody builds their program just a little bit different as far as how many investment versus saving features they have, whether they have a debit card, a prepaid card, a checking account. But all Able programs all follow the same guidelines as far as eligibility and and the maximum account balance of 100,000 before SSI is impacted, as well as the $19,000 a year contribution limit. So let's go ahead and go over to the next slide. Oh, this is just, I just wanted to brag a little bit more about this. The new mobile app, I really like it because I can just do things from my phone and it's really convenient. So we're just happy about it. Account holders have been asking about this for about 5 years, so we finally got it. So I just put that in there again to show you what that looks like. Okay, next slide, please. We'll go back to that Maryland Able Tax Incentive. Again, anyone that lives in Maryland, pays Maryland taxes, who contributes to a Maryland Able account can receive an income subtraction up to $2,500 per person per Able account. So if you have more than one child with an ABLE account, you can do that for both ABLE accounts. People that are contributing to the account, family and friends, they are also eligible for this. So that's nice. If the person is married and filing joint, they can claim up to $5,000. Okay, can you talk about restrictions or processes when moving out of state? So since ABLE legislation is federal and we have 47 ABLE programs, you can move to another state and have two options. You can keep your Maryland ABLE account with you because again, it's not part of just one particular bank. It's actually a bank account that's linked to an existing bank account of your choice. So when you move to say California, right? You could keep your Maryland ABLE account if you want, or you could roll it over to the Cal ABLE program, and there's no fees or penalties to do that if you roll it directly over to their program. And oftentimes we suggest that people take a look at the state of their residence, okay? Because there are benefits of being within your own state. For example, if grandma lives in Florida, she could make contributions to an ABLE account, a Maryland ABLE account, but she's not going to benefit tax-wise, right? It's the same goes in reverse. If you are living in Maryland and you have an ABLE account in another state, those contributions are not going to be an income subtraction on your Maryland taxes. So check with the state of your residence. All right, next slide, please. This is a highlight slide of just some of the numbers that we've talked about. And I just show this so that it gives you guys an idea to kind of look it over a little bit, see if you have any questions. But while you're doing that, do you want me to kind of go through the questions, or did you want to ask me some that you've seen?
Yes, I'm happy.
Okay.
So I actually have a list and I can ask them.
Perfect.
And then
Thank
some
you.
of them, if for any reason we already answered it, we can skip it because I know you went through a few of the questions.
Yes.
Okay, perfect. So the first question, okay, so does ABLE account funds affect FAFSA?
No.
No. Okay. We established an ABLE account last year. We would now like to make another contribution this year. It's a deduction available for 2024 if made now.
So contributions made in 2025, you could only take them off in 2025.
Okay, thanks. Can you transfer SSI fund into the ABLE account?
Yes, you can set up direct deposit of SSI funds, or you can manually electronically transfer those funds like I do for my daughter's account from her SSI Rep Payee account. I've linked it to her ABLE account, and every month I just move over that amount that she's not using. So I never have to worry about that balance getting anywhere near $2,000.
Okay, and can my child take the deduction if he puts money into his own account?
Yes.
Okay. Can you transfer funds from a Maryland investment account 529 to the ABLE account?
Yes, you can.
Okay. Does doctor's diagnosis report require to open ABLE account, or the IEP documents can be used?
So the person that's opening the account, let's just say it's a parent in this case, would self-certify at the time of enrollment. You would just check a button. This is my child's disability. he or she had it before age 26, and I attest that this is true. So you could open it without any of those documents. In the future, though, when you go to your next physician's visit for an annual checkup or even whatever, sick visit or whatever, take with you the disability certification form, which is available on the Maryland ABLE website under forms. And they're going to do the same thing. They would just check the disability code and they would sign it. You want to maintain it in the event you're ever asked to produce it. And the only one that would ask for that would be the good old IRS, because remember, that's where regulations are held for ABLE accounts. These are a tax advantaged savings account for people with disabilities only. And in the event that your child would ever be audited in the future, not because he or she has an ABLE account, but because they were just lucky enough to be pulled for a random audit, the IRS is going to want to know two things. Number one, does this person qualify to have this tax-free savings account? And that's where you would need to either produce that disability certification form or show that you're receiving SSI or SSDI. And the second thing they'd want to know is, how is this money being used? It's intended for the use of the beneficiary only. So that's why we want to make sure we maintain our documentation to show that withdrawals that are coming from the ABLE account are being spent on the person with a disability. So, in the case of when I registered for summer camp, I just printed off a copy of that receipt for summer camp. And if I ever needed to submit that to the IRS during an audit, I basically have a file for every year. ABLE account 2020, ABLE account 2021. I just put all my receipts in there. And if she's ever audited, I'm just going to hand over those file folders with receipts in it. Okay.
Hey, great. What happens if the person with this account passes away?
Okay, great question. So in that event, what's going to happen is two things. First of all, the money in the ABLE account can be used to satisfy any outstanding debts, including funeral and burial expenses. After that, the account can be closed and liquidated. Let's take the first case scenario. The person passes, the account's liquidated, it would be given to or sent to whoever is the recipient of their estate. So if they don't have a will saying where their estate should go to, it's going to follow those rules of probate. It's going to look at, does this person who's passed away have a spouse? Do they have children? Next, do they have a surviving parent? If not, do they have a surviving sibling? So whoever would be in line to receive that estate would be able to receive that estate. However, when they get that money, that person, unless they have a disability and qualify for an ABLE account of their own, would have to pay taxes on the earnings since that account has been open, right? Because this was tax-free savings for a person with a disability. So the money passing to a person, a non-eligible eligible person, would have to pay taxes on the earnings. That's one case. The other thing is, what about this Medicaid clawback that everyone's talking about all the time? I know Yolanda mentioned this as well. And in the case of a first party trust, that upon the passing, the Medicaid could recapture funds that were paid out. In Maryland, we have a letter from Maryland Medicaid stating that they will not seek recapture of ABLE funds unless federally mandated to do so. What does that mean? Maryland's not going to go do it, but the federal government still reserves the right to do that. And it's important to know that when your child receives any type of waiver service or any type of long-term care in the future, age 55 or older, they're accessing long-term care through Medicaid. Those funds that pay for these services come from two different sources. Federal funds and state funds go into making those benefits available. Maryland has said they will not recapture, but the federal government does reserve the right to do so for anyone age 55 or older who is in long-term care. I know that's a complex question and answer, but I hope that helps.
Yes, that's great. Okay, next is there any difference from Maryland Able and Able Now?
Great question. So again, Maryland ABLE is one of 47 ABLE programs nationwide. We're all going to follow the same IRS guidelines as far as eligibility, the standard annual contribution limit, the able to work contribution limit, and also that $100,000 account balance. What does differ from state to state is the features. So I believe in Virginia, I think they have a debit card and we have a prepaid card. They probably have a different selection of investment portfolios. They may have more, they may have fewer. I'm not sure. I know the state of Tennessee has like 11 different investment options. So for folks who are really interested in a variety of investment options, some people elect to go with Tennessee. We do have a great tool that we can recommend. It's a website called abletoday.org. I'm sorry, abletoday.com. And it provides you with the list of all 47 ABLE programs and lets you see the comparison between the different programs.
Okay, great. So the next question is, if your child goes abroad to study, will this be affected? And what happens if they move back from, want to move from the US?
So I believe to enroll in the ABLE account in the first place, they have to be a US citizen. So I don't think it matters if they're traveling because we have people that are in the military that are serving as ALRs and they are sometimes stateside, sometimes they're abroad. So as long as the person has US citizenship, they're able to have the ABLE account open and manage it.
Okay, great. Is DDA approval for Maryland Department of Health considered as a proper documentation for proof of disability?
Again, the only person that would be asking to see this would be the IRS. And if you're getting SSI benefits or getting SSDI benefits, or you have a one-page form with a disability code checked off and signed by your physician, that's all they need. So you could, if you were ever audited or if your child was ever audited by the IRS, you could present that to them. But we've made the form available because that's something that they accept readily. I'm not sure that we've even had somebody ask to produce it yet, but you could show that to them if you wanted to, in the event you were trying to prove that they were eligible.
Okay, great. Does the ABLE account expire after the particular age of the person? Like, is there an expiration date for the?
No, we have ABLE account owners that were that are a couple months old because mom and dad had a child born with Down syndrome and they know they're going to need this long-term savings and investment option for them. So, it is there as long as the person is alive.
Okay, and last question, will the federal government recapture funds for use of DDA self-directed services if they never go into long-term care facility?
That I'm not sure about. This is definitely something that, again, is for long-term care throughout their lifetime. I'm not really sure about that. They reserve the right to do that, I would imagine, but I can't say for certain because we haven't had that experience.
Okay, great. Well, thanks again, Yolanda. Yolanda, thank you so much. And Kelly, for your informative and helpful presentation. Looking ahead, our virtual transition times meetings will be held once a month from now until June. All meetings will continue to be offered with simultaneous ASL in Spanish and archived on the PCR website. The next meeting will be focused on housing and will be held on Wednesday, March 19th at 7 p.m. We will have information about Housing Opportunities Commission HOC vouchers and other housing opportunities. We hope to see you then. If you have not completed the survey, if you can please complete that. And hope everybody has a great evening, and we hope to see you next month. Thank you again.